This doctor went from buying property during the GFC when everyone else was running for cover to building a diversified commercial portfolio that's now cash flow positive and completely pays for itself.
The first big sort of property purchase was actually during the GFC, where everyone was running for cover, but I had cash in the kitty, and it was actually, I thought, a good time to invest, and it was, because by the time I liquidated that property, it'd gone up by 250%, which is quite remarkable.
Today on the podcast, I'm joined by anaesthetist, academic, and investor, Alwin Chuan, someone who not only survived the GFC and COVID market cycles, but used them to build some serious long-term wealth. In this episode, we break down Alwin's full journey from humble beginnings in Sydney's West to creating a diversified, recession-resistant portfolio made up of residential, medical retail, and industrial commercial assets.
I've gone from almost 100% shares to now less than 10% shares, but now wanting to sort of rebalance that so that when retirement comes, there's a nice sort of diversified portfolio across different types of asset classes with unconnected income streams.
In this episode, we talk about why Alwin held nearly 100% of his wealth in shares until recently and what changed his mind, the 3 commercial properties he's bought now through Palise property, including one that had 0-day vacancy and another one negotiating a 10-year lease, how he uses shares for growth, property for leverage, and trusts for asset protection, his transition into semi-retirement and how he's preparing for intergenerational wealth transfer, and the one team member he thinks is more important than your accountant, mortgage broker, or even buyer's agent. Whether you're a time-poor professional, an investor transitioning from residential to commercial, or just want to see how someone builds serious financial freedom without giving up their career, this episode you don't want to miss. Let's jump right in. Alwin, thank you so much for joining me.
No, thank you, Steve, for the invitation. A real pleasure to be here with you.
No, it's been a bit of a journey with us with Palise
Yes.
Property, but I think let's start at the beginning. So
Yes.
let's start, because you're obviously quite an established property investor,
Yep.
also into shares, but obviously established doctor as
Yes.
well. But let's maybe start right at the beginning, before you got investing, right from the start.
Right, in terms of where I am, in terms of career.
Where you grew up, and we can go from there.
Fantastic. So I'm one of the first generation migrants. So my folks brought the family over all the way back in 1981. So I've been in Australia for 40 odd years now, 40 plus years. And it was a very different Australia back then, I can tell you. So we grew up in the western suburbs. And what was really interesting was where we were, it was still very much semi-rural. Now, when I drive through that area, it is amazingly sort of residential.
Where was that?
So near the Blacktown area.
Yeah, okay, yeah.
So, we literally had a horse behind the fence because it was all a grassland. Going up towards Parkland Markets for people who
The
were
one
in
lane,
Sydney.
the one lane road.
The
to
one lane
Parkland
road.
yeah.
And it was still very much sort of farmland. It was like...
Kellyville didn't exist. Half
absolutely.
of the Hills District didn't exist.
That's
There
right.
was no Box Hill, Kellyville.
That's right.
Rural was farmland.
That's right. That's right.
World,
So it's a very, very different sort of Australia back then to what it is now. So I grew up fairly modestly. I remember the first couple of months we were basically just eating off sort of wooden sort of cardboard boxes that the shipping container came in. But it was a good upbringing because it was a very humble upbringing.
How old were you when you came?
I came in when I was 6, so some very interesting memories.
So still kind of semi-vivid memories then.
Oh, very, very much so. Yeah. So flew in on a Qantas plane, and then you had the biosecurity person come through the plane with a can of fly spray. so that was what they did back in the 1980s. And then walking off the tarmac, and then just experiencing a very different sort of world from where I grew up in, which was Malaysia. Yeah.
Okay. All right. So you went from there. I imagine did all the school in Sydney's West.
Yes.
And then did you go straight into medicine?
Yes, I did. So I did high school, went straight to uni, did medicine straight away. So there wasn't any sort of change in the undergraduate course. And then subsequently, after finishing my undergraduate degree, spent a few years in the hospital system as a junior medical officer before deciding on specialising in anaesthetics, which is what I'm currently doing at the moment.
What was the driver for anaesthetics? So I was was mentioning you off air, like I was actually married to an anaesthetist. She chose that because of general lifestyle. It seemed to be perception anyway, you tell me if I'm wrong, was you get to pick and choose your hours a bit more. It's not like a surgeon where you're working 12 hours a day necessarily. Was that it, or you just into that kind of field? It was just kind of gravitated towards in like your original, in your placements?
Yeah, I think it was actually a combination of things. And part of that is knowing what makes you tick. So it's about the personality. And one of the things that I was really interested in was some sort of excitement with regards to what you did at work. So it had to be some sort of passion. I couldn't really see myself doing a subspecialty where I was bored because this is going to be a 20, 30, 40 year sort of stint. So you want to do something that you actually enjoy. So I did sort of think about emergency medicine, but I remembered that in theatres there was a lot more camaraderie, a lot less politics, versus say emergency medicine, and I really enjoyed the fact that it was a one-to-one with the patient. So you had your full attention on the patient. You can look after the patient really, really well, both pre-surgery, during the surgery, and then after the surgery as well. So that really attracted me to it.
You'll probably laugh at this, but I remember when I first met my partner and they thinking about going to anesthetics, you think that an anaesthetist is literally just the person who walks up to you before a surgery, gives you a drug and then walks away. You kind of don't realize like on the surgery table, if all hell breaks loose, normally the anaesthetist is the one that comes in because they're in control of like bloods, airways, keeping them asleep.
Absolutely.
Surgeons generally just stitch, whereas in the movies, you're like, the surgeons are going to save them kind of thing.
Yes.
And I was maybe like, even when I was studying, I had to learn about like the physics of like the defibrillating machines and like it was high level engineering stuff that I had to know as well. So it's actually really kind of broad industry.
No, it is. And you touched on two very important things. One is that we're enablers. Anesthetists are enablers. So you think about when anesthetics was really sort of first came on, it was only fairly recently, like 1850s. Oh, wow. And prior to that, it really literally was a piece of stick and bite on this. And so all
pour a bit of alcohol on them.
Absolutely. So all the modern surgery that we take for granted today is enabled by anesthetists and our anesthetic drugs. The second thing you touched upon was that human engineering sort of factors. And that's one thing that I didn't quite understand before I did anesthetics, but now I really appreciate about anesthetics, is that it really is that case of human factors, engineering, how people interact with that interface. And that has a lot more factors in which can modify and can change the way that patients actually have a good or bad outcome. So designing things properly for humans is actually critically important.
I couldn't believe it when she was like studying. It was just like fault finding for machines. Like if you get an incorrect reading, knowing, is that an incorrect reading? Is it coming from the pipework? Is it coming from the electrical system? Is the machine faulty? Like there was this whole like systems you actually have to understand, which is not what most people realize. You're in the medical world, so you probably laugh at this, but like most people just think it's like nighty night, see you later. I'll see you in a couple of hours and make sure you're awake.
No, absolutely. No, that's true.
So I want to touch on a point where you mentioned, so it was quite like humble beginnings in Sydney's West. And then like we work with a lot of doctors in the doctors groups, as you know. It's a weird trajectory for like income and life for doctors. So like, you're going to end up on a certain income. Like generally speaking, like there's not many doctors that earn 50 grand a year when they're 20 years into it. How were you thinking about like investing back then, or was it survival? Was like when you were studying to be a doctor, because you don't get paid much. Then you do your registration and you get paid a little bit more, but the money only really comes when you get to basically be a specialist. Were you thinking about that then, or was it just kind of like whatever money you had, let's buy it shares or a residential property?
That's interesting. I think doing my undergrad work and then my junior medical officer sort of training in the 90s and the early 2000s, I think it's a very different sort of proposition compared to today. But one of the factors that was very helpful for me as an individual was that when I was in high school and I was doing economics as a subject, our teacher introduced us to share markets. So we actually did the ASX game, and I think a form of that still exists today. Because I did
that at university for engineering.
So I talked to my son, and he's actually doing it right now, and he's in year 9 in high school. So that introduction to share trading was very helpful because it got you interested in investing. It got you interested in how share markets worked. And there was a very low barrier to entry because
you can put in a little or as much as you want.
You can put in $100 or $1,000 and you can start trading. So I think that was the excitement that kept me going investing. And you didn't actually need to earn a huge amount of money to actually start doing that. Whereas, we'll talk about it a bit later, but property is a slightly different sort of scenario. So I think I've always been an investor, and I was lucky enough that I won a few awards when I was in high school and uni that had a monetary sort of a payout. So I used that money to invest. And I remember my first investment was actually in the T1, T2 tranches of, back then it was called Telecom Australia. And then based off the profits of that, I sold the shares and I went on a backpacking holiday in Europe. So, there was a nice,
speaking my language now, using money for experiences.
So it was good. So I think I've always been an investor, even from a fairly early age.
And then so you kind of continue that through your studies and went from there.
Correct, that's right.
All right, so let's jump into that. So I know you're a shares guy, you love shares. But when was the transition to property and why did you change? Was it like to buy a principal place of residence? Was it to buy an investment property, or was it diversification?
So I think I've always been a property investor, but purely from a personal sort of sense, buying a PPOR and so forth. And I think I've been fairly fortunate that the times that I did buy a PPOR were the times when the property market was depressed. But that's actually one of the core principles of investing, sort of buy when others are selling and then sell when others are buying. So bought the first big sort of property purchase was actually during the GFC. So everyone was running for cover, but I had cash in the kitty, and it was actually, I thought, a good time to invest, and it was. Because by the time I liquidated that property, it'd gone up by 250%. So, just in that sort of 10-year sort of period, which is quite remarkable. But in terms of investing beyond PPOR, that really only occurred after only occurred after COVID.
Is there a level of confidence with doctors, especially because you do have a very low risk job in regards to unless you do something very illegal, you're going to continue to earn income, and that means you can take on a bit more risk. Whereas I think a lot of the fear around GFC was people losing their jobs, but I think that might have gave you a bit of confidence as well of no, I can keep earning income and support this and go from there.
Yeah, so that is one of the pros and cons of being a medico. One is that you do have a stable income regardless, within reason, regardless of what's happening in the economic sort of point of view. Everyone's going to get sick. Everyone still needs to see a doctor, and hospitals still need to run, which is good in that point of view. And the banks reward that by giving doctors a much higher ability to borrow. The cons of that is that you're capped, at a certain extent. Business owners, for example, can really sort of scale up their business and their profitability far beyond what doctors can using their personal services income. So there is a bit of push and pull. So you can sort of ask the banks for a bit more money, and that can buy you in and give you that stability because the banks like you because of that. But it also is a very different ball game when you start doing investing because you're just treated like anyone else.
Were your parents into investing in property investment, or were they just in survival mode basically?
Yeah,
buy a house
pretty
and
much
look
so.
After your kids and get your kids into university?
Absolutely. So there were 4 of us, and I really admire my parents for taking that sacrifice, both socially. They left all their family and social networks back in Malaysia to start up a new life here, and it was all about giving opportunities to the kids, like all migrants do. But as a consequence, it really was very much a middle class sort of upbringing, and they were very conservative investors in the sense of money in the bank is good. There really wasn't that much money outside of that to actually invest.
I had a bit of a funny conversation with a client yesterday who was saying it's unfair that I can't buy property in Sydney, and I was like, well, hold on. I'm like, my grandfather couldn't afford property, so he bought land and built it on the weekend himself.
Yes.
So he didn't complain about that. My dad grew up in Bondi, couldn't afford Bondi, so he moved to Wentworthville, which is next to Blacktown, which is basically farmland. And now I'm getting young 24-year-olds being like, oh, I want to buy in the inner west. I'm like, No, you shouldn't be able to buy in the inner west. You should be making some form of sacrifice, then come back to the inner west.
Yeah, it really is. It's very hard to buy into places that you'd like to be, and maybe that's aspirational, but you've got to be realistic. Yeah,
it's just because Australia's so young. It's like if you live in near New York, you don't assume you can afford New York. You buy on the outskirts of what you can afford, but there's this weird kind of like, because we're only a few generations old in Sydney, for instance, that everyone thinks they should be able to be near their parents.
Yeah, culturally as well, I think, because we've always been sort of got that quarter acre block sort of dream that's been sort of put upon us, and as a consequence of that, we always imagine our homes to be of that sort of size or similar to what our parents did. But when you actually look worldwide, Sydney, Melbourne, Adelaide, they're all incredibly low density sort of urban populations. Nothing compared to New York, Singapore, Hong Kong, Tokyo.
I was in Vietnam, was it 2 or 3 months ago, and I couldn't believe I went to like a mountain and looked at the city, and it was literally to the horizon, skyscrapers. You don't get that in Sydney, but it's just it'll shift and change. I actually did an interview with Channel 7 yesterday about how more investors are buying the market, and we're actually shifting away even from home ownership being a thing. And it's like 70% of purchasers now are investors, which means home ownership is, if you want to get into it, you have to go on the outskirts.
Yeah. No, I've heard also that 10% are now rent investors. So I think that the trend will continue.
It's just education as well. Like you can see all this knowledge online, and you can do podcasts and books and stuff. Whereas even when I started 2012, there was a few books on the market, no podcasts. You kind of had to listen to people. Which I think that's a good kind of segue for. I found most medical professionals, until recently, maybe it's still that way, don't talk finances. Whereas other industries kind of do, but it's more of a, like when I was an engineer, like every day I was talking to my colleagues about property. Whereas doctors seem to be a bit more close guarded with it. For some reason.
We're incredibly sort of conservative and traditional. There's still very much a taboo with regards to things that concern money. And I think that's a gross failing. We are trained in medicine. And trained to look after patients, and that involves having a singular focus on the outcomes of the patient, but nowhere in that is what are the outcomes for you as an individual, and that has both financial as well as a mental, emotional sort of point of view. That's changing, and part of that is a growing acceptance to talk about this. Is not a taboo topic anymore, and of course, you just mentioned education. So there's a lot more podcasts now, and a lot more people willing to talk about it, and I think a new generation as well who have more willing. They don't have the same sort of constraints and straitjackets in terms of talking about things that perhaps the older generation did.
There's even like doctor conferences now that are based around investing and building a business. And like one of the funny ones, one of my really good friends is a surgeon. He got his specialist training finished, and then contacted me and was like, Steve, what do I do now? And I'm like, well, you got to, like, you're a specialist now, you got to have an office and blah, blah, blah. Secretary, he's like, how do I get an office? How do I negotiate a lease? How do I hire a secretary? And I'm like, why are you asking me? I'm the property guy.
we get no training whatsoever. I mean, as I mentioned, things are changing, and with the Society of Anaesthetists, so I can only talk about my craft group. We certainly run quite a few sort of webinars and information sort of nights. We call it the Part 3 course, where it talks about all the other aspects that the training never actually touched. We teach you how to look after a patient, what sort of drugs to give, and how to run the anesthetic machine, but we don't teach you how to run yourself.
Your life after training.
Absolutely.
Even how to pay yourself and do all that type of stuff.
All that sort of things. So I certainly learned by talking with selected colleagues, senior colleagues, because you do have this idea that with some people, that's a no-go zone, and other people you can talk about.
There's some people who are quite open and sharing, but I think there's huge opportunities for education there, like even online courses and things like that. So. All right, so we're shifting through the timeline. So first property, was that a residential?
That's right.
Was that with your partner at the time? Or
yes, correct.
Was that a principal place or an investment?
Principal place or residence, so that was 2008.
So you did the usual one, then bought that. 2008, so the market in Sydney, was it Sydney, I imagine? Started moving, 2012-ish?
Yes.
So kind of went from there. When did you get the next one?
Next one was 2019.
Okay, well, so a little bit of a gap.
Bit of a gap,
Was that just focus on work or more involved in shares?
I was still very much focused in shares at that stage, but in 2019 was thinking about putting a roof over my head, and again that was if you remember, APRA had just come in and tightened the lending criteria, and there was a correction in the market, and I thought this is a fantastic time to buy. So looking back at both PPORs, what was really interesting was that the seller was under pressure, and this was a fantastic opportunity to buy. So not only was the general market depressed, but the individual vendor was quite happy, quite eager to actually offload the property, which meant that you had negotiating power. Yeah.
Let's probably touch on that because you're obviously heavily invested in shares. Let's go over that because the whole point of this podcast is to educate. So what do you like about shares over property? You mentioned obviously you put less in, but you're a big shares guy. What's the driver for that? Because my argument is I like property because I can leverage.
Yes.
And I get to play with big dollars.
Yes.
Also means I can lose big dollars.
Yes.
But the market's been fairly kind to most people in the last 10 years that you've been up. But what's your kind of feel for that?
So the main resistance, if you like, for someone who's coming from shares to thinking about property is twofold. The first one is the entry barriers, and then the second one is legislation. So let's talk about the two of them. Yep. So entry barriers. So I've already mentioned that. It's very easy to get into the share market. You don't need a huge sort of deposit to actually start investing in shares. And you can, nowadays with ETFs, you can diversify your portfolio very easily with a relatively small amount of money.
You can also do it in regular payments as well, almost like once a month when I get my pay, I put in the X percentage and just slowly chip away.
You could do that. You could do that. But those ETFs did not exist when I first started share investing back in the 1990s, but it's so easy now, and the online broking is so much easier now. I remember, 20 plus years ago, I had to sometimes put in a postal form to actually buy and sell shares. So it's so easy now. You flip up your phone, punch a couple of numbers in your app.
Any of the banks do it. So I'm with NAB. You're literally in the online banking. There's NAB trade, and I'm going to put in $5,000 into this share, and done.
Absolutely. So I think the barriers to entry are quite low for that. The other sort of issue is discovery. So when you want to trade or buy a stock, often there's a lot of information that's available. The AGMs, you've got financial reports. So, this goes back to that due diligence sort of thing. So there are some similarities between share trading and share purchasing and property investing. And part of that is that due diligence and discovery, making sure that you're buying a good stock and so forth. So all of that is much more transparent in the stock market as opposed to the property market. So there's entries to barrier. The entry barriers are a lot lower, for shares. So that's the first thing. The second one would be the legislative sort of issues. So as soon as you buy a property, particularly investment properties, then you're sort of bombarded with a whole bunch of things that you had to deal with that you never really had to deal with stocks. When you buy a share, the share price goes up, share price goes down.
No one talks to you. It's just there.
Yeah, it's there. So you can buy and sell according to the numbers right in front of you, and there's really no legislation, to stop you from doing all of that. But when it comes to property, then you've got to wade through all the different sort of issues that goes along with investing in property. Tenants' rights and who deals with this and who pays for that and leasing.
Valuations and
all sorts of stuff. And then the big thing that you just touched on is leverage. So you can leverage in shares. So we call them margin loans. But usually the margin loan or the LVR is going to be a lot less than what you can do in property.
What do you typically see for LVRs for margin loans?
It really depends on your risk. So you can certainly do a margin loan really high, but it's inadvisable because if your stocks that you bought with a margin loan tanks, then you're going to get a very sort of a nasty phone call from your broker saying that you either need to liquidate your shares or to top up the share account to bring the LVR back.
That's actually in reality no different to property.
It is.
If you buy a property for $1 million and it tanks to 700K, the argument will be, well, you can do the holding for that. But when you're doing the high margin loans, do you have to put like collateral? So you put up like a property or other shares? Or?
So the shares are normally the collateral.
Yep, okay.
Yeah. You can, like I said, leverage even more and start putting other sort of assets as security for that. But then you're really starting to deal with a very high risk because unlike property, and while it's true that property can reduce in value, they're not going to reduce in value overnight. Yeah. Whereas when you look at a stock market, some shares can tank 20% just overnight.
Evaporate.
Yeah. So if you're at the edge of your margin lending sort of criteria, then you could have a very bad phone call at 4:30 p.m. saying that by tomorrow morning you need to top it.
Do they change the margin lending like LVR effectively based on the type of share? Like if it's a low risk share,
so some lenders will insist that you have a certain type of share as part of your margin lending. Others are a bit more lenient, but a lot of it, like I said, depends on your risk appetite. You can always find someone to lend you money, but there's always going to be a sting in a tail.
Be a catch. Okay,
yeah, absolutely.
This is obviously not financial advice for those listening, but like, what's your general strategy with shares? Is it normally like you try to go more speculative, or you do a portion of that, or you buy really low risk and you play the long game?
Right.
Or does that change over the time of your career as you earn money?
Yeah, no, absolutely. I think if there's one theme that I would suggest to the listeners is financial literacy, and you're always learning. And one thing about the stock market is that it really shows you, it's a real truth sayer.
Yeah.
So, if you get it wrong, you will be punished. And there will be times, when you're on the mountaintop, sort of shouting, hooray, I've won big on this, but there's other times when you're on the ground with your shirt on fire. So it's a great leveler. There's a lot of people who talk big, but for people who've been in the game for decades, you're going to have your wins and your losses. And
the people who talk big are just talking big because they've got the thing. They're never talking about. It's the old like, I used to go to the pub with my mate and he'd come back from the pokies being like, $200, Steve.
That's right.
And I'm like, I literally saw you put multiple $50 notes into that pokey machine. But you came back boasting. I'm like, I don't think you've earned that much.
No, absolutely. So a lot of people sort of trumpet their wins, but they're very quiet about their losses. But I think the long-term investor will see that, you're going to get some wins and some losses. So going back to your question, in terms of how to invest, that's certainly changed over time as I've learned more about how the game works and what my risk benefit sort of proposition is, because that also changes with time. Very different when you're single and you're in your 20s and you think that you've got a long sort of time frame to recoup your losses versus now where you've got dependents, you've got loans to pay off. You can't sort of play the risky game as much as you did 20 years ago. It's
one of those ones. Is it this? The more shares are more emotional than property because you're getting constant feedback of what they're worth. Because I've got like friends that go, share market dropped 80 grand today. And I'm just like, well, are you going to sell? And they're like, no. I'm like, well, why do you care? Like almost to the point of, why are you checking?
Yes.
But I had this when I was an engineer. I used to sit in the office. The guy next to me literally was the shares guy. And every day at lunchtime, he was there looking at his shares. And I'd say, well, are you going to sell or buy? And he goes, no, I'm just looking at it. I was like, well, why? Which is sort of probably one of the pros of property, but it's also the negative, like you mentioned, is once you've done it, you actually get like this mind release of like, okay, I don't have to worry about that until there's a problem. Whereas shares, I think it's more of an active, almost like an addiction.
No, for sure. There is a certain sort of adrenaline rush with shares that you don't get with property, simply because the way it evolves is much two different sort of speeds. I, in the past, used to have a trading portfolio and then a longer term portfolio. So I generally had
like the high risk trading one and then the
correct.
longer one.
So it was like an 80-20 split. So long term is for the not so volatile stocks. And then you've got a 20% sort of portfolio for, the more speculative, more volatile sort of stocks. And I have to admit, the long-term stuff is good because that's what it is. It's the bedrock. But you get more excitement from the trading stuff.
The highs and the lows, I imagine. From
absolutely. Absolutely. But it also teaches you a lot because when you trade using those sort of more speculative stocks, it really shows you just how nimble you can be or nimble you should have been.
And you learn the lessons faster as well.
Absolutely. And it's a brutal game. It's a brutal game. But over time, I've realized that I don't have the time anymore to actually do as much of that sort of share trading as I used to. And secondly, like I said, dependence and sort of other sort of constraints on what, how much you can afford to lose. So while the gains are certainly very good, can you really afford to, lose that amount of money? And, over time, those circumstances change. But who knows, when I retire and, the retirement is secure, I may well sort of open up that trading account again.
Yeah, but then it's not for necessity, it's for literal fun.
Yeah,
it's
for fun.
Just educational fun.
Correct.
So what was the shift? So when you bought the second residential, was that just diversification, moving the PPOR, and then what kind of flowed on after that? Was it more residential?
Yes. So decided that after COVID, and that was a fairly existential sort of threat as an anaesthetist, and after I had the headspace to actually start about investing again and start looking beyond sort of medicine, it really was a case of, let's start that investment journey again, and that is to look at residential properties. Yes.
But again, that was just for diversification effectively, like the shares, you're doing well, but like let's just get some, I call it like bricks and mortar bank account effectively.
Yes, yes. And the main sort of driver for that was leverage.
Yep.
I can leverage a lot more and buy more with property than I could with shares.
Yeah. You might disagree, but I always argue that like buying very boring residential property, I think is always going to be lower risk than shares long term, just because like there's always going to be a need. And as we're talking off air, like you need housing, you need somewhere to live. But then, like you said, once you've put all your eggs in one basket, you're done for quite some time.
Yeah. So it's really interesting. So two things I would say to that. The first one is that they did a recent analysis, and there's always going to be a conversation about, which is better, shares versus property and so forth. So what was really interesting was that the top three sort of investments over the last 30 years in Australia, the first one is actually gold,
really?
interestingly enough.
Yeah.
So gold has appreciated the most in that sort of time frame. And 2 and 3 are almost the same, shares and property. Yep. So, it's a case of you get certain things with shares and you get certain things with property. And I think if you want to be a bit more holistic, then diversification, you get a bit of both. So they'll be good.
I always argue this, and it's probably the same argument for properties and shares. So in the property market, people go, oh, what's like the best location to buy? You're only really trying to get the best location for the next 5 to 7 years. Over 20 years, they all grow exactly the same, because what happens if one grows more than the other, people shift to the more affordable locations, and then that's where the cycle goes. And I imagine the same thing would happen with shares. If shares were outperforming property, for instance, people would start jumping on that until the point they stop outperforming shares, and then they jump back. And so you're always just it's gonna be like a chicken and egg chasing the whatever's kind of growing. But on average, they have to match the market. Like otherwise, if shares had 2% more than property over 30 years, it would be 5-6 times the price. And same thing with property. So I think they're always going to be somewhat level with the market and inflation. The aim is just to beat the market by a couple percent.
So the adage is that the money will flow to where it can grow the best. Yeah. So if the share market is relatively better valued than property, then money will flow there, and vice versa. Absolutely.
Okay. All right. So keep buying residential, and we've obviously crossed paths for the commercial side, which we'll go into that. But what was before commercial, what was the general strategy? Was it just keep accumulating shares, keep accumulating property, do some other ventures? No,
actually it was very much after sort of accumulating the residential properties, the play there was to think about retirement. Okay. So I'm sort of getting towards a stage of my career now where retirement is actually more of a reality as opposed to some far away sort of outcome. So how can I sort of ensure that I have the wealth required to actually fund that retirement that I had in mind? And then, to extend beyond that, what about intergenerational wealth transfer and what to do with the kids and so forth. So residential ticked some boxes, but not every box. Yep. And in the same way that, I talked about shares, and you had one portfolio that, did the boring stuff, and then another portfolio that did, another sort of, it ticked another box. Same thing with property. Residential property ticks certain boxes and commercial property ticked other boxes that residential could not match.
Were you aware of commercial kind of, because we obviously met at some doctors' conferences and some mutual friends that had commercial properties as well, which I think was the kind of fun.
Yes.
Were you looking at that before then?
No. What was really interesting was that I was pretty much interested only in residential property, and it was through those connections that I started thinking a bit more seriously about commercial. And part of that was the appeal of yield from commercial, and to be honest, also that distance between the tenant and you, because in a commercial property, commercial tenants have very strong sort of agreements in place as to what you can do and what you can't do and what the rent is and who's liable to pay for X, Y, Z. Whereas I think it's not as clear cut in residential. And you've talked about this quite a lot in terms of capital growth and so forth, but versus yield. And certainly residential properties do not tick that box in terms of yield. It's a very, very poor yielding sort of investment, but it does tick the box for capital growth. Whereas commercial property definitely ticks the box for yield, and hoping that the capital growth will also match residential as well.
I actually released an article last week showing the basic last 20 years of every residential capital city versus the commercial capital cities, industrial and retail. And like I mentioned, they all pretty much grow the same. Funnily enough, Sydney commercial was the top, but like they were all pretty much, again, 6-7%. They all actually end up being the same. But that's funny because the first commercial we got you was a medical type one. We got you a pharmacy.
Yeah, that's right. That's right.
So that was the first one of three. Do you think that was a bit of an easier one for your decision because you somewhat were aware, or you just knew that like, okay, pharmacies are pretty low risk?
I think all of that. The location that you found for me was perfect with regards to being in a high growth metropolitan area. So there was going to be a lot of foot traffic. It was located as well within a medical precinct. So there's going to be people who visit the GP and will be giving a script, and then, well, I'll just go to the pharmacist that's right next door to the GP practice and get it filled out. So there's a lot of synergy there, which is obvious, for building that sort of medical sort of model. But more importantly, it was in a growth suburb. So it's not going to be a place where people are going to move out, going to have less foot traffic. It's right next to a major shopping centre. That suburb there is growing. So part of that discovery period, part of that due diligence is to actually tick those boxes off, that even if for whatever reason, the pharmacy decides to move on, can I rent out that space for something else?
And the vacancies there were really tight as well. So
very tight.
But then as we were talking off air, you're getting close to negotiating another 10-year lease on it. Which,
correct.
Once that's signed, happy days, that's headache free.
Absolutely, headache free.
Okay, so we got the pharmacy as like a really good bulletproof, low risk, basically retail type property. So the second one we got was an industrial.
Yes.
Diversifying from the retail medical in Coolum Beach.
Yes.
Which is really good there. What were your thoughts on that one? Because you like warehouses because it's just like
it literally is the box, and so many different types of tenants can go into that. Again, it ticked so many boxes. So when you presented to me the due diligence report, and I did my own sort of research as to the potential growth in the area. Southeast Queensland is just booming at the moment with the Olympics and extra infrastructure going in. I can see a very long sort of period of continued growth. Land is scarce. So it really ticked all the boxes in terms of future-proofing that investment for capital growth. And the fact that it's a industrial warehouse with, tilt doors and so forth, lots of tenants. So since I bought it, I've actually had a second tenant move in, essentially taking over the business. And it was just seamless. So I quite like that as opposed to, for example, residential property, which can be quite troublesome trying to find a tenant.
Well, if you don't mind me asking, what was the kind of vacancy period on that? Because that's people's biggest fear with commercial is that, like, I'm going to go buy this asset, or they're going to buy an asset themselves and it's going to sit there for 12 months. But what was the vacancy period on that one?
0 days.
0 days. Okay, there you Any incentives or anything like that?
Nope.
No? Okay. So just basically like probably a releasing fee from the property manager of the
pretty much
15% or whatever it is.
Yeah,
and
pretty much. So the second tenant essentially took over the lease of the first tenant.
0 days. It's
0 days.
Not even like residential. Residential, they'll leave. Like I'm moving out of my place at the moment. They have like, oh, we'll leave 3 or 4 days just in case like it's delayed or we have to get a cleaner in and blah, blah, blah. So that was like straight. Okay, that's perfect. So,
yeah, it's perfect.
Feel good story there.
Yes.
And then again, we bought another commercial after that.
Yes.
Again, just a low risk. We weren't particularly looking for commercials, but like if we found something else like in a retail or multi-tenancy, we looked at, but we got another thing. And the main aim of that portfolio is just a nice little diversified. We're diversified in different locations.
Correct.
We've got 2 bulletproof tight vacancy rate industrials.
Yep.
We've got a bulletproof tenant for the pharmacy.
Yep.
And it's also versatile. If they leave, it could be kind of any type of medical
anything.
or
Correct.
hairdresser or whatever it kind of be. So we've got those 3 new ones now and a nice little diversified portfolio. What's the general strategy now? Is it keep going? Is it consolidation? Is it pay down? Is it shift back to shares? We're talking about kids schooling and all that stuff. Is it get that out of the way and then worry about the leftover money?
No, it very much is now about deleveraging. I've pretty much maxed out the LVR and I'm very comfortable with that. In fact, all of the properties are positively geared. There's actually nothing owing on those properties. So all of those are earning good income for me. And you mentioned about shares. And so, I've gone from pretty much almost 100% shares to now less than 10% shares.
Oh, wow. Okay.
But now wanting to sort of rebalance that so that, when retirement comes, there's a nice sort of diversified portfolio across different types of asset classes with unconnected income streams. So you mentioned, the commercial properties are in different locations, which is great. It also is looking at different tenants, which is great as well. All in growth areas, which is great because, if I do want to sell the properties in the future, then, I should be able to bank some capital growth there. I've got the residential property portfolio, which is doing its own thing. And then I've got shares. So I want to really diversify those income streams so that I can, weather any storms in the future because
you got the perfect, like traditional, nice split of all the portfolio. And because most thing that holds people back for property investing is when it's negatively geared, it's the unknown of like, when am I going to have to stop dipping into this?
Yep.
The good thing, because you're positively geared, if we just keep getting rental increases, let's say 3 to 5% rental increases year on year on year, that portfolio and LVR will just start shrinking because the value will grow. And that's the cool thing about commercial.
Yes.
When you get rental increases, you get the capital growth.
Yes.
So you win on both fronts. You start paying down the property effectively and the LVR is dropping based on that.
That's right. Basically just let time do its thing. Yep. And in the meantime, start paying down so that you've got a bit of a buffer.
Yeah. You touched on a point that we're talking off air about, you said like getting the right team.
Yes.
And you said the most important person in the commercial property portfolio is who?
Property manager. Yeah, absolutely.
Not your buyer's agent, property manager, which I actually agree with you because they are make or break.
Yeah. Well, you actually do need to have a good team. You need to have a good accountant, an accountant who actually understands structures and understands investing. So not just a bookkeeper.
Yeah.
Like a lot of accountants are essentially bookkeepers, and you need accountants who are like that. Yeah. But you also need an accountant who can help you structure things properly so that you can really sort of turbocharge the way that you invest. Your mortgage lender is going to be absolutely critical because they can wrangle deals for you that potentially you will not be able to go to enter with, for example, the Big Four. They can start looking at secondary sort of lenders and so forth, or they can get a private bank, for you and so forth.
And have experience working with doctors as well, because you guys have a few more gates open that most people don't.
Absolutely. One thing, that becomes very apparent is that, you've got numbers and then you've got a story to tell. So you can have all the numbers and spreadsheets that you like, but unless you can stitch everything together into a good narrative to sell to the bank, you're not going to get the loan that you're hoping to achieve. And that's where the mortgage broker really sort of pays for itself.
That's actually an interesting statement because you're 100% right with that, but most everyday investors don't think of that. They just think, get rid of my credit cards, just get it all sorted. But like you said, if you can create a good narrative, it's still storytelling.
It's still very much a storytelling.
This is where I'm going. This is what I'm doing. This is my risk profile. I'd say it's easier to do when you're a medical professional or a business owner because you can craft narrative. Whereas, no offense to those, if you're a police officer or a nurse or just something like a more normal, typical job, much harder to kind of craft a story. But why did you say property manager? So is that
so the rest of the team, yourself, buyer's agent, so that they can source that solid sort of a bulletproof sort of deals, so that you can actually achieve those outcomes you're hoping to achieve. And then finally, the property manager, because at the end of the day, whether it be residential or commercial, unless you want to be your own property manager, which is not something that I would suggest that people do, unless it's a full-time job for you. But
even then, you want to make sure you've got the experience in it. Like I've had clients where they manage it and they just forget something like doing the fire compliance.
Yes.
Doesn't sound like a big deal, but if it actually burns down, do you think your insurance is going to cover it? No,
absolutely.
Like over one little inspection.
Yeah, absolutely. So unless you actually are doing this full time and you've got your wits about you, then it's not something that I would recommend. So trying to find a good property manager is worth their weight in gold. They can interface with a tenant. You don't have to hear all the abuse. They can negotiate things on your behalf. They're your interface and
get you 0 days vacancy.
Get 0 days vacancy. Like, that's an interesting story, that one. So I think, not knowing the full details, I think that poor chap was going through a marriage breakdown. So he wanted
We've both been there.
Yeah, that's right. So he wanted to liquidate his assets. And so he wanted to offload his business. And so the property manager went out and found someone who was quite willing and quite happy to actually expand upon his existing business, take on this extra business and move into that expanded warehouse space. And that's the reason why it was a 0 day tenancy. And because it was an ironclad lease, which you need to have with a good property manager, they can negotiate that for you. That first tenant had to keep paying the rent until the second tenant moved in. And so that's why it's, from my perspective, no cost to me, because even if there was more than a 0 day sort of tenancy, I'm still going to be paid by the first tenant until the second tenant moves in. As it turned out,
beautiful.
0 days.
Oh, that does make sense. Yeah. It is. It's just having someone good can literally save you so much money. I've got a retail property that's next to a train station, and there's 10 car spots out the back. And they're like, the tenant doesn't need 10 car spots. Can I rent them out? So they rent out 8 of the spots. Gives me an extra $8,000 a year.
Fantastic.
Like just, and I'm not doing anything. She organised all of it. She organised individual contracts for all of them. And just literally just a smart property manager saying there's more money here.
Yeah, no, fantastic. No, that's great to hear. And I think as passive as we want our investments to be, we still need to be involved in some, sort of shape or form. So, shares, you're constantly sort of actively looking at it. And, I actually quite hate the term passive ETFs because there's no such thing. People shouldn't look at ETFs as being passive.
There's no such
you're
thing
still
as,
looking at things.
There's no such thing as passive investing.
But
I'm guilty of it. I say a passive income. And people say, oh, you're lucky, Steve, you got a passive income. It hasn't felt passive. It's been 12 years of staying up till 1 a.m, reading every book, podcast, running a successful business. Like there's been nothing passive about it.
Yeah, absolutely.
It's the fruits of your labor.
Absolutely. Correct. So even when you present deals to me, for example, I do my own due diligence, and
doctors are the worst, by the way.
So, you do your own research, you do your own council reports, I look at flood, zones and so forth. So I just want to make sure that, what is presented to me is actually correct. And then when you actually do buy the property, then you're still interfacing with the property manager because things turn up, roller doors, fail, or the termites, have been discovered in the property sort of area. So what are you going to do about it? So there's still going to be some participation, some involvement at some level, but you can minimize a lot of those headaches by choosing the right property, and making sure that the property being presented is
I'll give myself a bit of a self-plug here as well. The good thing about a buyer's agent that stays active as well, so we'll touch base with you every 6 months any moving forward, because even though you're in the consolidation phase of paying down, it'd be nice for you to know in a year's time, like, oh, this Coolum Beach property is actually worth 500 grand. Go talk to your mortgage broker, because it might be better shifting your money elsewhere or pulling out some equity, put it in shares or consolidating, whatever. So having that ongoing kind of check is probably my piece of advice. Is people think property is passive because you buy it and forget. No, there should be literally a 6 month check-in every single time on property. With everyone, accountant, mortgage broker,
Absolutely.
property manager, buyer's agent if you're using one.
Yeah, no, absolutely. I have a 12-month sort of strategy meeting with my accountant scheduled so that we can talk about, what's happened in the last 12 months, what we can do for the next 12 months.
I talk to every client about like investing and the why with it. So over this journey, was there a why? Was it like for passing on to your kids, or was it just building wealth? Or me and you, we loved scuba diving. We're talking about that off here. You just got back from the Philippines for a week scuba diving there.
Yes.
Was there any of that, or is it like I don't take any offense by this, but doctors are very tunnel vision because for the first 20 years of their career, they have to be.
Yes.
Where I found sometimes outside of that, outside of doctors, people were like, oh, I'm doing this because I want to work part-time or this.
Yes.
Was there a purpose, or was it just let's make some money and build some wealth to give me options later on?
Yes, I think retirement really is the that milestone that I was shaping my outcomes, or aligning my sort of financial milestones against, because while nowadays you can sort of semi-retire and work part-time and so forth.
That's what I was going to ask, because anaesthetist it kind of allows you can say I want to work 2 days or phase out slowly.
Yes, but you want to have that flexibility, you may well decide, look, I've had enough of all of this, I really want to fully retire, or there's still some, gas in the tank, there's still some passion projects that I want to pursue and I only want to do that 2 days a week. But unless you actually have the financial means to do so, you don't have that opportunity to do that. So what I find really curious about medicos, and perhaps more generally, is that people get very focused on their careers and they want to put money into time into their careers. But what they don't perhaps realize is that they need to spend just as much time looking at their retirement. Even though it may well be 20 years, 30 years in the future, as we all know, time in terms of letting money compound and so forth is going to be very important. And you may well miss opportunities. And every so often there are opportunities where you can strategically come in and buy when asset prices are much lower. And so that your profit margin is going to be that much bigger if you actually have the means as well as the acumen to actually dive in at that moment in time.
It's literally doubling your wealth plus kind of thing by doing it. Like you said, they get focused on the time because that's where they make the money. But if your money's not working for it, one of the stories I tell is my old engineering boss who was getting close to retirement, and this stuck with me. This is early on when I owned like 2 little cheap residential properties. He was like, the property I bought, he had one investment property, and he bought it like, I can't remember, 20 years ago. It's probably more than like 25 years now. And he's like, that's earned more money, that one property in growth, than my whole career earnings.
Yes.
And I was just like, why the hell am I working?
For sure.
I'd be better off stripping back the work and focusing more on the investing side, which I did.
For sure. So the 2 takeaways from there is that, one, investing follows a power law. Often it's the 1 or 2 deals that you do that actually make up the vast majority of portfolio. And that's what a lot of people don't appreciate, that, people talk about diversification, but they're not diversifying for the sake of diversifying. They want to make sure that they've got as many chances as possible to pick that 1 or 2 outstanding investments that really sort of make the overall portfolio look fantastic.
That would apply to shares as well, I imagine.
Absolutely. So in fact, the power law actually was first sort of described for stock markets, and the reason for that is because every day there's millions and millions of share trades, whereas you don't get the same liquidity and the same sort of volume of transactions with property. But the same thing happens in property. So that example that you gave speaks very much to that. I think the second thing that we also have to appreciate as well is that asset prices are rising faster than incomes can catch up with. So you need to get some form of investment in a growth asset, because if you think that in the days before the 1980s, it was all about working hard, saving lots of money, and then you can sort of buy whatever you need to buy.
Buy a house, buy one investment property.
Absolutely, that's right. But if you don't actually get into the market soon, then you actually miss that boat, because those asset prices will outgrow your ability
you're effectively going
to have your income.
You're going backwards because cost of everything is outstripping what you're earning.
Yeah, absolutely.
Which It is hard for doctors because like I went through it. Like my partner did 4 years pharmacies, 4 years med school, 2 years intensive residency, and then training, blah, blah, blah. It was such a long slog to get to the point to earn money.
Yes.
To then not focus on actually earning that money.
Yes.
Is like a detriment. But like
Yes.
you said, they need to somehow get the energy and kind of foresight to actually start investing. Weirdly, you don't even have to do it well. You've just got to buy like quality assets.
Yes.
I think a lot of, especially doctors, you've been great to deal with, get so focused on like trying to get the minuscule win of like, it must be that 10 grand off the price. But in reality, it means nothing.
Yeah. Over the 10-year, 20-year period of the investment, you know, so what? Yeah.
I saw a cool graph the other day. It was an upside down triangle, and it was basically what affects the property's return on investment. First 70% was location.
Yep.
Like, but people think, oh no, that's only like a small part. And then 2% was the purchase price.
Yeah,
Two,
right.
which
Yes.
makes sense because
It
you
makes
buy
sense.
$1 million asset.
Yes.
And whether you get it for $990 or $1.010 million, if
Yes.
it's worth literally $2 million in 10 years time,
Yes.
that 10 grand over 2 mil is not a big percentage.
No, it's not at all. So you sort of have to give it, you know, that sort of long-term perspective, you know, particularly when it comes to property, because like, you know, you're not going to buy it and sell it, you know, normally, or you're not going to be flipping it in a couple of years. So when you actually have that longer-term view, then it all washes out.
So what's the plan with you? And you don't have to answer this, but like, do you think you're just going to put a big stop on work, or do you think you'll just kind of phase out slowly, or will you get? I know you're getting more involved in like boards and like running events and stuff. Do you think that's probably the direction you're going to go?
Yeah, I think so. I think I'm fortunate enough that there's quite a lot of different projects that I'm involved in. In fact, I've got multiple fingers and multiple pies.
Sorry to cut you off.
Yes.
Do you still enjoy being an anaesthetist, or have you been doing it for so long?
Absolutely. You know, the three main hats that I wear, you know, first of all, I'm a clinician. So I still enjoy giving an anesthetic. There's nothing like giving a good anesthetic and seeing a patient have good outcomes.
I never thought I heard that quote. There's nothing like giving a good anesthetic.
Oh yeah, absolutely. And you know, it's quite interesting because we all need to have some form of quality assurance. And you know, at the very base level, I'm talking very coarsely here. You know, a live patient is actually a very good outcome. But you then start to think about other outcomes that are of importance to a patient. Things like not having delirium, not having, you know, cognitive decline after surgery. You know, having good pain relief, having good functional outcomes, being able to get out of bed and walk. You know, the day after, you know, your knee replacement and hip replacement. Those are all very important outcomes, not just for the patient, but we also know in terms of data. That the faster to get out of bed and start walking, you know, the better the functional outcomes are going to be. And that speaks a lot to the second hat that I wear, which is as an academic. So I do a lot of research in terms of, you know, perioperative outcomes, very involved in how technology interfaces with my craft. So, you know, ultrasound and virtual reality, and more recently, artificial intelligence, and how this is all going to change the way that we interact with, you know, with patients. And then finally, I'm a medical educator. So, you know, I was just recounting with one of my fellows only recently that I've actually taught 3 generations of anaesthetists. Wow. So it tells you how old I am.
You look great, by the way.
Yeah, thank you. It's all that salt water. So it's been a great journey. I've been, you know, very privileged and very humbled to actually have all those different sort of aspects. So talking to your question about, you know, will I want to retire completely? I'm actually not sure. There's lots of things at the moment.
That's a good position because it means you're still enjoying what you do.
Absolutely.
Yeah. Normally retirement is I hate my job.
Correct.
I can't wait until pull the curtains down.
I mean, I certainly do have exit sort of pathways. So, you know, like in 5 years' time, I would have paid off enough of, you know, my loans to actually, if I wanted to, retire fully. I doubt it because there's still a lot of gas in the tank. There's still lots of things that, you know, get me out of bed and get very interested in. Lots of new projects that I'm doing, which is, you know, involves meeting new people, doing new things that I haven't done before. And that's, you know, both a challenge as well as exciting to do. Yeah. So I'm not entirely certain is the answer. I think there's still going to be, I'll be around for a little while longer.
You mentioned the word privilege and not in the terms of like wealth privilege, but I was presenting at a doctor's conference a few weeks ago. You probably know the one anyway.
Yes.
And they were talking about that. They said doctors are in a very privileged position that you get to earn a decent income whilst also giving back and getting the feel good. Whereas not a lot of careers get that. Like when I'm an engineer, there was no feel good outside of me fixing a challenge and designing something good. With designing a mine site. Like there's no like, oh, I'm contributing to the world. So you get that kind of tears of happiness where you're giving back, you're still providing for your family, you're kind of getting that, which I think's really great. Like it's almost like a perfect job. There's negatives, as you know, with like stress with medicines and mental health and all that type of stuff. But I think that's hopefully changing.
Hopefully changing. I think, and this is going to be different for everyone. Everyone has different sort of financial goals and what they're trying to achieve, and that speaks a lot to the individual about their own values and so forth. But certainly, to me, retirement, or at least preparing for retirement, is about that financial security and independence to be able to say, I'm going to pull the plug and be able to do that at my own terms, as opposed to getting the tap on the shoulder and saying, I think it's time for you to leave. So there's one aspect of that. The second aspect is, we talked about intergenerational wealth, and with my kids, teaching them about financial literacy and getting them interested in investing and what it all means. But also, I think in the Sydney market, the way things are, the bank of mum and dad, I think we'll have to come to the rescue. But it's not so much a gift, but giving them the same sort of opportunities, same sort of financial independence, so that they can pursue things that they really do enjoy, as opposed to, having to go to work because they have to go to work. So unshackling them from that.
I've always said this, like me having a passive income, it doesn't stop me wanting to work. It actually makes me enjoy work.
Correct.
Way more, because you don't have to bear. I use the word arrogance, but I kind of say that in a kind way. I'm arrogant now with my time. Like if I get someone who I don't think is going to be a good fit for our company or whatever, you say, look, don't think we're a fit. All the best for investing. Here's some other companies, blah, blah, blah.
Absolutely.
Whereas when money's dependent, you have to like put food on the table.
Yeah, you've got to put a smile on your face and turn up to work.
But that's what causes the unhappiness, is that the mask that you have on every day.
Correct.
And that's what I found. It gives me arrogance, but it means I don't have to work. And you're more rigid with your hours. You say, oh, actually, I don't have to work today. I'm going to cut off at 4 p.m. And just reduces the stress, I think.
Absolutely. Absolutely.
And I imagine the same thing happens with retirement.
Yeah, I think so. But I think what's really good in this current sort of climate is that retirement is now a very fuzzy sort of thing. In the past, it used to be very much boom, and that was it. You get your golden handshake and your cufflinks and off you go. But people now are very much very open to the idea of that stage retirement, 5 days to 4 days, 4 days to 3 days, and so forth. And even that can be different, because it could be 5 to 4 days to 3 days in your main job, but then you've picked up 2 days of extra work, but it's a passion sort of job, like you're volunteering at
education that you're doing.
Or education, or I'm starting to get into global health sort of issues in the Asia Oceanic sort of region. So spending more time sort of developing networks there and so forth. So it gives you that independence, that sort of freedom. You call it arrogance, but I think it's just that freedom to actually say what's really important for me, and I'm going to stick to those values.
Yeah, the reason I don't like the word freedom is because it implies we're not already free. Like you are free to quit a job you hate. You are free to like earn more money, less money. Like you've got that kind of choice. So it's kind of something within. It's like a mental state for me. And that's why I don't know what the word is. Maybe I need to work out what the word is. But there's a word about like it's like the necessity of not having to do something.
Enablers,
yeah, that's a good word.
Yes.
Yeah. It enables you to do what you want.
Exactly.
So I think that's a perfect way to end this, Alwin. Thank you so much for coming.
No worries. It's been a real pleasure.
Thank you so much.
Thank you.
Cheers, guys.